Hi, I'd like to introduce Chris McAlpine, who is the co-founder of Context Capital, who we at Securitas have engaged as our asset consultants. Most recently, Chris was the Senior Investment Analyst at WA Super. Today, Chris will be giving us an investment performance overview of our separately managed account models.
Following a period of very strong returns coming out of the GFC and then a further period of strength after the initial fall in COVID, markets experienced a significant downturn in the first quarter of this year. The primary reason for the sell-off in markets this quarter is inflation, and what inflation can mean for the potential path of interest rates moving forward across the global economy. The sell-off in markets was broad-based, hitting both equity and bond markets and affecting most countries across the world. Initially coming out of COVID-19 lockdowns, inflation seemed as though it might be a transitory problem. Supply chains snarled up as the economy had trouble restarting after a period of almost complete shutdown during the pandemic. Unfortunately, it appears as though inflation will become a structural issue moving forward. In part, this is a result of those supply chain issues. There is the simple fact that it takes time to restart things like factories and foundries after a period of shutdown. And as consumer demand has skyrocketed coming out of COVID-19 lockdowns as economies have reopened, capacity has struggled to meet demand, leading to supply chain issues. Compounding this effect, China has aggressively pursued a zero-COVID strategy, which has resulted in the lockdown of large parts of their manufacturing sector, which has only added to inflationary pressures. The war in Ukraine, while primarily a humanitarian tragedy, has also added to inflationary pressures, as Russia and Ukraine account for a large percentage of the world's exports of wheat and commodities. Together, these factors are contributing to make inflation look like it will move to a structurally higher number than we have seen over the past couple of decades, and likely to stay that way for some time. This structurally higher level of inflation has caused central banks to shift their policy as well for the first time in almost a decade. Starting from historically low interest rates, central banks are now being forced to raise those rates in an effort to combat inflation. These rate rises by central banks have mostly negative implications for investors. The potential for inflation to cause a consumer spending slowdown has contributed some pressure to equities. A bigger factor over the quarter, however, was simply the rise in interest rates. When interest rates rise, it puts pressure on equity valuations, which coming into the quarter were at a historically high level. When interest rates rise, it forces investors to reconsider how much value they place on cash flows that are likely to be generated far into the future. So technology companies, in particular, where investors are banking on high future cash flows, sold off very heavily as rates rose and investors reconsidered their positions in these stocks. The overall result was that the tech-heavy NASDAQ index fell by almost 10% over the quarter, while a broader measure of US stocks fell by almost 5%. The picture across global markets, while not as grim as that of the NASDAQ, was also a significant sell-off. The Australian market fared slightly better, as our indexes skewed more towards banks and commodities, which did not have as rough a time. Bond markets were also significantly negatively affected by the rising interest rates over the quarter. Bond prices and interest rates tend to move in opposite directions. What this means for investors is that, as interest rates rise, bond prices fall. The result was that the first quarter of this year was a very tough time to be a bond investor. As the central bank in Australia indicated that rate rises would be coming, Australian government bonds fell by over 6% during the quarter. The US and other central banks also indicated that significant rate rises were coming, and so a broader basket of global bonds fell by more than 5% over the quarter as well. However, in other parts of the portfolio, interest rate rises and inflation do not necessarily mean as much trouble as they do for share and bond markets. Over the long term, property and infrastructure investments have the ability to pass on rises in inflation and interest rates to their end users. If we think about assets like houses or toll roads or airports, each of these things has the ability to increase prices in line with inflation. And so while the short-term effect may be to depress these prices as well, in the long term, we expect that some things within our portfolios can actually benefit from rises in inflation and rates. There are some types of alternative assets which can also be structured in such a way that they can benefit or at least not fall as much as equity markets when inflation and interest rates rise. Given these post-pandemic and post-war trends, we believe that there's likely to continue to be significant pressure on inflation and therefore on interest rates over the short to medium term. Given that we think it's likely there will continue to be upwards in pressure on inflation and interest rates, there are a couple of things we can do to try to position our portfolios to stay ahead during this tough time. Securitas's portfolios invest across a range of different asset classes outside of traditional bond and equity markets for diversification. We do this so that we're not overly reliant on any one segment of the market or any one country. For example, in addition to investing in share and bond markets, Securitas's portfolios also hold investments across property, infrastructure, and alternative investments, which are not as sensitive to inflation and interest rates as more traditional asset classes. Even within our equity and bond portfolios, we make sure that we invest across a range of different styles, in an effort to make sure that while some things may not be working, other things will be. For the bond portfolio in particular, we have been careful to make sure that we are not overly reliant on interest rates for performance. This means that Securitas's bond portfolios have outperformed the broader bond markets over this quarter. Lastly, we can structure portfolios in such a way that we are able to move quickly, actively rebalancing our portfolios back towards our target weights and making sure that everything is staying on track.